Welcome to Trust TV, a show designed to give insight into the mind of a professional investor. Asian markets faced challenges in 2022 as rising inflation, higher interest rates and growing concerns of a recession dampened investor sentiment. North Asian markets, which are more dependent on exports and have greater exposure to technology, were particularly hard hit, whilst their southern counterparts were more resilient. However, as 2023 begins, there is reason for optimism. China has begun to lift lockdown restrictions, and inflation and interest rates in many economies in the region are starting to subside. My name is Simon Longfellow, and in this episode, we speak with Mike Kerley, Portfolio Manager of Henderson Far East Income, to discuss how he navigated those challenges in 2022, the reopening of China, how businesses are managing higher input costs, and the dividend outlook for the Asia-Pacific region. Mike, welcome to the show.
Hi.
2022, no doubt a difficult year from the point of view of the portfolio, but also from the point of view of global markets. Tightening rather than easing of monetary policy and higher interest rates and inflation having their impact. How did you navigate all of that in 2022?
Well, you're absolutely right, Simon. It was a difficult year. And what made it more difficult, I think, was that we had global themes and, as you say, interest rates, monetary policy, inflation, and all these, depending on which bit of data arrived, dictated market movements. So for a stock picker, it was quite difficult when you get these big picture things moving the stocks almost irrespective of what happens with the company. So I think for the year as a whole, we had some clear themes and they started early in the year. We believed that energy prices and gas prices were well supported even before Russia invaded Ukraine. Clearly, subsequently, that proved to be very beneficial for us. We were nervous about China at the beginning of the year, thinking that, well, we were hoping it would reopen, but didn't think it would until the latter half of the year at the earliest. We try to allocate more towards Southern Asia. As you mentioned, the southern markets are more resilient. We did that to a degree, but to be honest, yield isn't that prevalent in the Southern Asian market, so we couldn't really do that. So we kept hold of these themes of trying to play consumption, trying to play the global thematics, trying to play global demand and supply with obviously our yield hat on and trying to generate enough income to continue to pay our shareholders. On the whole, I think it was a mediocre year for us. What we hoped would be defensive in some cases wasn't. Utilities usually are defensive and great ground for yield investors. Same with consumer staples, but they were affected by input prices from gas and electricity or from rising food prices or packaging prices. So it was difficult for everybody. And as an income investor, maybe it was more difficult than probably we'd hoped it would be.
Okay, well, let's talk about this kind of north-south divide. North Asia in 2022 was a relative underperformer, less so in the south. Is that diversion going to continue in 2023?
I don't think so. I mean, to be honest, China is what makes the difference here. Clearly for North Asia, it's got more technology involved and is more dependent on global demand for semiconductors, chips, laptops, iPhones, all this kind of stuff. And that's going to be impacted by the weakening economy globally. However, China is also a big consumer of these goods. And if China reopens, which we're seeing the tentative signs now, then demand for North Asian products, North Asian trade will improve. On the other side of that, South Asia, India in particular, which has benefited from people not really wanting to invest in China, is now starting to see a reversal of some of that outperformance we saw. So it's the winners of 2022 are currently the losers of 2023 and vice versa.
And what about the portfolio there? How did you reposition the portfolio, bearing in mind that kind of north-south thing?
Well, we have really since the fourth quarter of last year, really, and certainly since the announcements of China reopening. I think if we can hang our hat on anything this year, and it's really difficult with interest rates and inflation and what happens with commodity and energy prices, very difficult. But what we can hang our hat on, I think, this year is that China will reopen, China will grow, and that growth will increase as we go through this year. So in a world of uncertainty, that's probably as certain as we can be about something happening which will impact our portfolio.
Okay, let's talk about tech. It was sold off heavily last year. Again, inflation worries, interest rate worries. Valuations now seem to be at a more attractive level. Is there anything else that you need to see in order to get into tech in a big way?
Well, I think we need to break tech down because we're still a little bit nervous about semiconductors. And semiconductors are what goes into loads and loads of different goods, which are mainly consumed in the Western world rather than in emerging markets. And our view is that the Western world is going to struggle over the next 12 to 18 months. On the other side of tech, you've got the internet sector, e-commerce and this, and that's a different story. That plays in much more into consumer demand and more, especially in the case of China, focused on emerging markets rather than globally. So we have a more positive view on the internet space than we do on the semiconductor space. However, as we go through this year, you mentioned valuations, semiconductors are attractive. It's just picking your point, I think, as to when the market starts pricing in the recovery.
Now, let's talk about the yield on the portfolio, currently throwing off about 9%, which is high. What's driving that high rate, and is it sustainable?
Well, there's two things, I think. The first, I mean, I've struggled to believe it's that high either, to be honest. And I think the reason is because the underlying valuations of the companies we own are too cheap. They're paying out too much money. So I fully expect our yield to fall over time, but not because the dividend falls, but because prices rise to reflect the undervaluation. Is it sustainable? Yes, I think so. I mean, Asian companies are generating a lot of excess cash. We are getting a lot of income from materials and the energy sector, which maybe we can't rely on in the years ahead, but certainly at the moment they are throwing off a lot of cash and it's coming back to us as dividends. I'm pretty confident as Asia grows this year, and it will grow, the growth will be positive 2023 over 2022, which I don't think we can say for any other region around the world. And as a result, earnings grow, dividends grow, and our income is sustainable, in my view.
Okay, so let's talk about China in a bit more detail then. Obviously, the reopening that's happened has sort of lifted optimism, lifted sentiment somewhat. And you've talked a little bit about what the consequences in China might be. What about for the rest of the region there?
Well, yeah, you're absolutely right. I mean, it surprised us, the speed of the reopening. We didn't think that China would do it over the winter period. But it looks like they're going for herd immunity as quickly as possible, which is typical China, to be honest. If you're going to do it, get it done. So we're seeing large swathes of the Chinese population now infected. And as a result, that's having some impact on Chinese production. Supply chains are going to see disruption. I think going forward, once we get past that, which will probably be the second quarter of this year, we'll start seeing the Chinese be a bit more confident, not only about spending domestically, but also traveling. And that, I think, is one of the big points for the rest of the region. You know, Thailand has been in the doldrums because it used to have huge amounts of Chinese tourists, which just disappeared overnight. And you can make the same argument that a lot of people used to go to Korea for duty-free shopping from China, and to Hong Kong, Macau. All these places are going to benefit from the Chinese traveling again. You've also got to remember about trade. Korea's largest export market is China. We all talk about Korea and Taiwan being all about the US and Europe, but the biggest trading partner for various goods is China. Now, obviously, China's been very weak, so trade between those two countries has been down. So you've got that benefit. You've got trade, you've got tourism, and the other thing is probably materials and energy. The oil price has come off recently because people have been focusing about weak growth in the West. However, China hasn't been growing. China will be growing. China is a big consumer of energy. It's a big consumer of commodities. So that will benefit places like Australia, certainly, if commodity prices and energy prices remain elevated. So there is certainly some benefits for the region as a whole, and the world, to be honest, because if China's growing at 5-6% next year, it could be the only decent engine of growth globally. So yes, it's important for the region, and some countries benefit more than others.
Is that the number, 5-6%? I mean, Beijing came out yesterday morning and said sort of 3%. Other people are saying 1%. I mean, it's a very difficult number to judge.
Yeah, 3% was for last year. So 2022 was 2.9% GDP growth. which was better than most people thought it was going to be fair. But for this year, I think Q1 will be quite weak because, as I say, there's a lot of people being affected, less mobility, some production halts, etc. But Q2, we could see double-digit GDP growth in China. I've seen some estimates in that kind of level. Whether we get that or not, I'm not so sure. But 10% plus GDP growth and the rest of the world seeing less than 1 is quite significant. And as we go through the whole year, 5% plus, I've seen some over 6% for GDP growth in China for 2023. It's possible, depending on how much the Chinese push that button.
Okay, let's talk about some of the sectors within China. And property has had some stimulus, some help as a sector, but there's an argument about whether that's enough to make it a sustained recovery for property. What's your take?
I don't think property's the driver of growth in China, not just this year, but ongoing. Xi Jinping's made it pretty clear that property is for living, not for speculation. And a lot of what happened in terms of the restrictions on the property market was to meet that goal. Property prices rising 0 to 5% or in line with GDP growth is fine. But beyond that, then that goes against the common prosperity theme, which Xi will hang on to in perpetuity. So if you're not getting anything from property, we don't think you'll get much from exports because, again, the rest of the world's not growing, so who do you export to? We think fixed asset investment will continue to be a driver, so upgrading of electrical power grids, etc., roads, infrastructure, but not maybe as much as we've seen in the past. But the big one is consumption. Consumption at the moment is a lot lower percentage of GDP than, say, the US or the UK or Europe. And Chinese have got a lot of excess savings, which they've accumulated over the last 3 years. And we talk about revenge spending in the rest of the world. This could be revenge spending on steroids, because the Chinese have accumulated something in the region, we think, around $2 trillion of excess savings over the COVID period. I'm not saying that's all going to get spent in the next 2 or 3 years, but a large percentage of it will as confidence returns. So I think consumption is the area which is where the real beta, if you like, comes from in the Chinese sectors. Okay,
and finally on China, I don't suppose we can talk about China and not talk about the relationship with the US. I mean, they've come out recently and banned TikTok on federal devices. That relationship doesn't seem to be getting any better. How are you assessing the US-China risk?
I think actually at the margin it is getting better. And the reason it's getting better is because it's not getting worse. So post the G20 meeting between Xi and Biden in Bali, there's been more meetings between the Americans and the Chinese in different areas of defense and this, that, and the other. We also saw in Xi's New Year speech a much softer tone towards Taiwan than what we'd seen previously. We also saw the Chancellor of Germany visiting with a group of corporates. This looks like to me that China is softening its stance to the rest of the world. Whether that continues is difficult to say, especially with the Americans, because visits to Taiwan by political parties in the US will always be massively contentious. But on the whole, I think the relationships at the margin got a little better, which is good news.
Okay, that's China. Let's look at some of the other countries in the region. India has a forecast GDP growth of 6.1% next year, which looks relatively attractive to other parts of the globe. Has that changed the investment case for the country?
Well, there is an investment case for India. It's just very difficult for an income investor because the valuations are high. So when the rest of Asia, really the valuations have come down over the last few years, India's gone the other way. So the difference or the premium that India trades over the rest of the region is at an all-time high. Now, there are some great companies, but it's the private companies in particular trade at valuations which we just can't entertain. The state-owned companies are cheaper, but then obviously, they're state-owned companies, so they're not particularly professionally well managed and they're subject to government policy. So it's very difficult, I think, for a value/income investor to invest in India. And to be honest, we have some doubts about the Indian economy in the next 1 to 2 years, i.e., we have a positive view on oil. If oil prices continue to rise, India is a massive importer of oil. That will put pressure, we think, on the fiscal account, as India tends to subsidize fuel prices. That could have some inflationary impact on interest rates, impact on the currency. That's not in the price in the market currently.
So let's move to Australia. It's a significant part of the portfolio for Henderson Far East Income. Household debt is relatively high. They're suffering in the same way that we are in the UK with interest rates and inflation. How are you taking that into account when you're investing in Australia?
Yes, we don't have much exposure to domestic Australia. Most of what we own in Australia is mining companies, energy companies, global financials, rather than necessarily companies exposed to the things that you just mentioned. I think Australia is going to struggle with those high levels of debt and elevated property prices, which are coming lower. And there is a risk on consumer spending for the economy as a whole. But the energy sector and the mining sector is what we think is playing into the drivers of the global economy. And China will be a big reason why commodity prices remain elevated. So the best part of Australia for us is the bit that plays into other parts of the world, not necessarily Australia.
There is a view that the Australian economy is also heading for recession. What's the investment case for holding cyclicals in that environment?
In Australia, well, cyclicals in Australia, domestic cyclicals, I would totally agree. But we don't really own those. And I think it's probably a little too early to say that Australia will go into recession. Australia is the lucky country. Throughout the recessions we've had in the rest of the world, Australia has managed to avoid those. And the reason why it's avoided those is because it has this very large energy and mining sector, which has offset some of the pressures which avail themselves domestically.
Okay, let's think about 2023 then and your kind of investment outlook for the region.
I think it's an interesting year this year. I think the difference between Asia and the rest of the world, and I take it emerging markets in this as well, is that the pressures we saw last year will probably not be the same again this year, i.e. the pressures of the strong US dollar. We think the dollar's probably peaked as we get closer to the peak in US interest rates. We've seen weakness in the dollar. That's usually a very positive sign for risk assets and Asia and emerging markets in general. We also think because of reopening of China, that'll have a positive impact on growth for the region as a whole, and that'll look incredibly good relative to the rest of the world, which is going to struggle. It's a positive case, I think, on an absolute basis, but it's a very positive case on a relative basis to other investment destinations.
Now let's talk about dividends, though, because that's really what the raison d'etre of the portfolio is. You've got the risks of inflation, interest rates, COVID, in China. Outlook for dividends?
Again, I think it's fine. There's some areas which will be difficult to gauge. You tell me what the oil price is, and I'll tell you what Shell will pay as a dividend. That kind of dilemma is something we'll think about over the next 12, 18 months. When you look at BHP and Rio, again, dictated to by their outlook for commodity pricing. We have a positive view. We think they will continue to pay dividends probably above what the market expects. But we don't have a crystal ball in this, so we can't really tell. But the recovery, I think, we have earnings growth, we have GDP growth. All of that will translate to higher earnings, higher cash flows, higher dividends for the region as a whole. And some of the areas which we couldn't look at dividends for in 2022, we can now look at in 2023. So maybe the mix will be different, but I'm pretty happy that the levels we saw in 2022 will be higher this year than they were in last, and that obviously helps us as an income fund.
Final question. The global economy obviously is suffering from some of those same headwinds. What distinguishes Asia from the rest of the world in that sense?
Well, I think the rest of the world is paranoid about inflation and what level of interest rates we need in order to cap inflation or put inflation to bed, if you like. In Asia, we don't have the same pressures on inflation for the main part. Partly because we don't have the same wage pressures. There's a shortage of labour everywhere across the Western world. We don't have that in Asia. You look at China, where you have 16, 17% youth unemployment. We don't have those wage pressures. We also don't have the asset price bubble, which the rest of the world is struggling with. Because excess money was never produced in the same way as it was in the UK, US and Europe, which went into inflating asset prices. That didn't happen in Asia. So we have less pressure on inflation. As a result, interest rates haven't gone up as much in order to counter it, and we think they'll come down a bit quicker. So that's the kind of macro picture. The bottom-up picture also looks better. We have underlying growth. Companies are making money. They can invest, which we're beginning to see. Companies here, companies in the US and Europe, capital expenditure's down. In Asia, it's flat to higher because there is opportunity. And that's the difference. It's opportunity as opposed to a weak or deteriorating outlook.
Okay, well, that's all we have time for today. Thank you very much to Mike Kerley for being our guest. We hope you found the discussion useful. Now, we have more Trust TVs coming up, so if you do have any questions you'd like answered by a fund manager, you can get in touch via the Janus Henderson Investment Trust website page. And if you like today's episode, you can subscribe and find more content like this via the Janus Henderson Investment Trust YouTube page. And if you want to hear more from our fund managers, make sure you subscribe to Trust Radio, the Janus Henderson Investment Trust podcast, on all major podcast platforms. Goodbye for now.